Silver can look perfectly in stock on a screen, while the real-world supply chain is already behaving like it's being rationed. That's the contradiction right now that can send prices higher in a hurry. Because silver isn't just a shiny asset people argue about on social media, it's an ingredient. It's the metal inside solar panels, electronics, medical devices, power connections, and industrial systems that don't get to pause production just because a commodity price is inconvenient. When an ingredient gets tight, the price doesn't politely drift higher over 2 years, it snaps higher when the market finally admits the shortage is real. And the market has been flashing signals that should not be ignored. Silver trading around the $108 area and surging through the 110s in the spike wasn't just a chart event. It was a reminder that this metal can reprice violently when positioning, physical demand, and supply constraints collide. Let that sink in. A move that big, that fast, doesn't happen in a sleepy, well-supplied market. The question isn't whether silver can ever see $120. The real question is, what kind of structure produces a move to $120 fast? Fast enough that most people only notice after it's already happened. That structure is built on one simple idea. Paper pricing can stay calm right up until physical demand forces the price discovery mechanism to re-rate the metal in a hurry. Silver is uniquely designed for that kind of surprise because it lives in two worlds at the same time. It trades like a precious metal when fear spikes, and it gets consumed like an industrial metal when the economy electrifies. That combination creates a market that can go from range-bound and boring to vertical and chaotic with almost no warning. Here's what needs to be understood clearly before anything else. A shortage does not mean there is no silver on Earth. A shortage means at the current price and within the required timeframe, deliverable supply cannot meet demand without the price moving higher to ration demand or incentivize supply. That's it. That's the entire definition. And that is exactly why silver can run to $120 faster than most people expect. Because the market doesn't need to run out of silver, it only needs to run out of willing sellers at the current price. Now connect the dots. Silver trades in multiple overlapping arenas: spot, futures, and the large over-the-counter settlement world. The spot price is the reference for immediate delivery. Futures are contracts to buy or sell silver at a set price for delivery at a specific time. And the OTC market, especially the London system, handles massive volumes that don't show up as a simple exchange trade on a retail chart. All of that sounds abstract until one question is asked: available to who, at what price, and on what timeline? Because a lot of silver is there, but not for sale. Some is strategic holding, some is long-term vaulted ownership, some is tied up in supply chains. Some is held in forms that aren't immediately deliverable for specific contract requirements. When demand surges, those distinctions suddenly matter, more than opinions, more than headlines, more than vibes. This is where terms get thrown around, so definitions matter. COMEX is a major futures exchange in the United States where silver futures trade and where delivery can occur through exchange-approved warehouses. LBMA refers to the London Bullion Market Association ecosystem, a central hub for bullion settlement and vaulting data. Registered inventories are metal in exchange warehouses that is designated as available for delivery against futures contracts. Open interest is the number of outstanding futures contracts still open. Delivery notices are the formal process steps that indicate delivery is being demanded and assigned. Then there's contango and backwardation, two words that sound intimidating until they're made simple. Contango is when futures prices for later delivery are higher than the spot or near-term price, often reflecting storage and financing costs. Backwardation is when near-term prices trade above longer-dated prices, often signaling tightness, because the market is saying metal is worth more now than later. And then there are premiums, the real-world markups above spot that buyers pay for coins, bars, and immediate supply when the pipeline gets stressed. When a true physical stress phase begins, the symptoms often show up first in premiums, borrowing costs, and near-term pricing pressure, not in a neatly packaged headline. Here's a concrete anchor point. LBMA's published London Silver Vault holdings at the end of December 2025 were 27,818 tons, roughly 894 million ounces when converted. That number looks enormous, and it is enormous. But here's the twist. A big total number does not automatically mean easy supply. It tells what is held in the vaulting system, not what is actively offered into the market at today's price. Ownership can be sticky. Some holdings are strategic, some are simply not for sale without a much higher price. In a stress phase, that stickiness tends to increase, not decrease. Now zoom out further, because short-term stress only becomes a true crisis when it sits on top of a structural imbalance. The global silver market has been running tight enough that major surveys have described large deficits and record or near-record industrial demand. One widely cited snapshot reported a global market deficit of 148.9 million ounces in 2024 and industrial demand around 680.5 million ounces. The exact accounting can always be debated, but the direction is what matters. Industrial demand isn't a side dish, it's the main course. Let that sink in. 680.5 million ounces of industrial demand in a single year. When a market repeatedly runs deficits, it survives by drawing down buffers, above-ground stockpiles, inventories, dishoarding, recycling shifts, and supply chain adjustments. That can work for a while, but every time the buffer is drawn down, the system becomes more fragile, and fragility is what creates speed. Because when the buffer is thin, the market doesn't have to climb, it has to jump. Now ask a simple question. What happens when a large buyer shows up who doesn't care about squeezing out the last 50 cents and instead cares about securing material? The answer is the price changes fast. That can happen through several realistic pathways, none of which require a fantasy storyline. A sustained surge in physical buying from a major region that treats silver as strategic or simply sees Western benchmark prices as mispriced. A supply disruption in mining, refining, or shipping that narrows the flow of deliverable bars. A delivery cycle where more participants stand for delivery than usual, forcing the system to source metal into deliverable pools. A macro narrative shift, rates, currencies, risk appetite, that turns silver into a momentum trade on top of already tight physical conditions. When those forces converge, silver becomes the kind of market that gaps higher, because it is relatively small, relatively volatile, and highly sensitive to flows. This is why silver has a personality that frustrates almost everyone at some point. It can make someone feel brilliant on Monday and humbled by Friday. And that's exactly why $120 can happen fast once the market starts behaving like a stressed commodity instead of a sleepy chart. Now, a quick historical parallel. Not because history repeats perfectly, but because it rhymes in how markets behave under stress. In 1979-1980, silver experienced a dramatic spike during a period of intense speculation and supply control attempts. In 2011, silver surged to nearly $50 during a post-crisis era where monetary anxiety, investor inflows, and momentum combined into a powerful trend. Different era, different drivers. Similar psychology. When people believe supply is tight and price is rising, the rush for exposure becomes its own fuel. In a small market, that fuel burns hot. That's how parabolic phases are born. Now here's the piece that ties the UFIDC's modern setup together. Silver supply doesn't behave like a simple on-off switch because a large portion of silver production is byproduct production, tied to the mining of other metals like copper, lead, zinc, and gold. That means a higher silver price helps, but it doesn't automatically translate into a quick surge in new supply. Mines don't get built overnight, refineries don't expand instantly, and even if the incentive is there, the timeline is slow. That lag is exactly where tight markets become fast markets. Because demand can show up quickly, while supply responds slowly. And industrial demand is not easily turned off. Manufacturers can thrift and substitute, but redesign takes time. In the short run, demand is less flexible than most people assume, especially in high-performance applications where silver's conductivity and reliability matter. So when the market shifts from silver is cheap to silver is expensive, demand doesn't instantly collapse. What often happens first is scrambling, restocking, hedging, securing supply, building inventory buffers. And that is when the benchmark price starts chasing reality. Now pause, because this part is important. A fast move higher can coexist with real physical tightness and still be vulnerable to a sharp correction. That's not a contradiction. That's silver. Parabolic phases invite profit-taking. Volatility triggers margin increases. Macro can flip. Liquidity can thin. And tourists, late arrivals chasing headlines, tend to become forced sellers at the worst time. That's why silver can drop 10% or 15% in what feels like minutes, and then turn around and rip again. So the goal isn't to believe in a straight line. The goal is to understand the roadmap of how $120 becomes plausible and how risk behaves on the way there. Technically, the big psychological level is $100. Round numbers matter because human behavior matters. A market above $100 changes how people talk, how funds allocate, how headlines get written, and how retail attention behaves. It also changes how hedgers respond, because contracts and budgets are often anchored to round thresholds. In a move like this, the market tends to revolve around a few zones. $100 becomes the level everyone watches. Lose it, and the narrative can shift from structural repricing to speculative blow-off, at least temporarily. The recent high zone in the low to mid 110s becomes the breakout reference. If price pushes back through that zone with strength, momentum systems often pile in, and short covering can accelerate it. Then $120 becomes the magnet, because it is the next big round number, the next psychological target, and the number people repeat until it becomes self-fulfilling. From $110 to $120 is roughly a 9% move. In many assets, that's a big multi-month journey. In silver, during a volatility spike, that can be a week. And that is why $120 fast isn't a fantasy phrase in a tight market. It's a description of how small, stressed markets behave. Now, here's where it gets really interesting. The physical stress signals that are not always found on a retail chart. Watch premiums. When coins and bars trade far above spot, that's a supply chain signal. Watch near-term tightness signals, borrow costs, lease rates, and the curve structure. When it becomes expensive to borrow silver for short periods, it often means demand is urgent. Watch delivery behavior and warehouse categories. Registered metal is the deliverable pool. Eligible metal is stored but not designated for delivery. That distinction matters because the market can show lots of metal while the deliverable pool is tight. Watch whether physical buying persists even during price pullbacks. That's a big tell. If dips get bought aggressively by real demand, the floor rises over time. Now, important, there has to be a real bearish case. Otherwise, this becomes propaganda, and propaganda is useless in markets. Here's the bearish case. If silver stays elevated, demand destruction can begin. Not everywhere, not instantly, but it begins. Some industrial users can thrift, some can redesign, some can delay non-critical uses. Over time, high prices incentivize efficiency and substitution where possible. Profit-taking is real. A parabolic move is a magnet for sellers. Silver can correct 20% without warning and without changing the long-term story. Macro can turn into a headwind. A stronger dollar can pressure metals. Higher real yields can pressure metals. A global growth scare can weigh on industrial demand in the short run, even if electrification trends remain intact over the long run. Market structure can intervene. Exchanges can raise margin requirements during volatility spikes, which forces some participants to reduce positions. That can cause sharp, sudden pullbacks even inside a bullish trend. And finally, crowding risk. When a narrative becomes popular, positioning becomes crowded. Crowded positioning breaks violently when the market moves against it. So yes, $120 is plausible, and so is a gut-wrenching pullback on the way there. Now for the bullish reinforcement, the part the bearish case doesn't change. The core setup remains: strong industrial demand, slow supply response, and a market that has been described as running deficits large enough to draw down buffers. That is the type of environment where price can re-rate quickly because the market needs a higher price to balance the system. In other words, this is not just speculation, this is a material that gets consumed. That matters because consumption creates urgency. Consumption creates restocking behavior. Consumption creates the kind of bid that doesn't vanish just because a chart looks overbought. Now shift into practical mode, because the most useful thing is knowing what to track. A short checklist can turn confusion into clarity. Track vault and inventory data trends rather than one-day headlines. Track physical premiums, especially if major regions are paying above benchmark pricing. Track the futures curve, whether the near months are unusually tight compared to later months. Track delivery behavior and warehouse categories if those reports are accessible. Track positioning shifts through public reports like the COT, commitments of traders, because extreme speculative positioning can amplify both rallies and corrections. And track whether pullbacks are being bought quickly, because that tells whether real demand is stepping in. Now, implications, because not everyone listening has the same goal. For physical holders, the focus is availability and premium, not just the quoted spot price. In stress phases, premiums can rise even when paper prices wobble. That's one of the most confusing realities for new participants. For traders, the focus is volatility and structure. Silver can move too fast for ego. Respecting levels, defining invalidation, and sizing appropriately matters more than being right. For long-term investors focused on the multi-year thesis, the focus is whether the structural drivers remain: industrial demand, supply response lag, and buffer tightness. The path will be messy. The destination will never be a straight line. Now, verification, because independent research is the difference between conviction and blind hope. Look up LBMA vault totals and compare month-to-month changes. Read major supply-demand surveys and focus on industrial demand and deficit framing. If comfortable with futures mechanics, review delivery activity and warehouse categories to understand how the deliverable system is behaving. Compare what the paper market implies to what the physical market is signaling through premiums and tightness indicators. Don't take anyone's word for it. Verify independently. Because when the data is understood personally, emotional whiplash loses its grip. Now bring it home. A move to $120 doesn't require the world to run out of silver. It requires the market to realize that the deliverable cushion is smaller than assumed, and to reprice silver quickly enough to ration demand or pull supply out of hiding. That's why $120 can happen fast. Not because of a magic prophecy, because of a mechanical reality. Tight markets reprice violently. 3 takeaways: simple, clear, and worth remembering. A shortage is not no metal exists. A shortage is not enough deliverable metal at this price on this timeline. The signals that matter most often show up before the headlines: premiums, near-term tightness, curve structure, and delivery stress. Volatility is not a side effect in silver. It is the core feature. That means corrections can be brutal even in a bullish environment. Full risk disclosure: this is educational information, not financial advice. Silver is volatile. Markets can reverse suddenly. There are no guarantees, and independent research matters. And here's the final thought. Hold it for a moment, because it's the part that separates surprise from preparedness. If the market is truly entering a supply stress phase, the biggest mistake isn't missing the exact top or bottom. The biggest mistake is assuming silver moves slowly, right up until it proves again that it doesn't.